Tobin's Q, 1, is the ratio between a physical asset's market value and its replacement value. It was introduced in 1968 by James Tobin and William Brainard, although the use of the letter Q did not appear until Tobin's 1969 article A General Equilibrium Approach to Monetary Theory. Tobin writes, 1. The numerator, is the market valuation, the going price in the market for exchanging existing assets. The other, the denominator, is the replacement or reproduction cost, the price in the market for the newly produced commodities. We believe that this ratio has considerable macroeconomic significance and usefulness, as the nexus between financial markets and markets for goods and services. Measurement equals single company equals, although it is not the direct equivalent of Tobin's Q, it has become common practice in the finance literature to calculate the ratio by comparing the market value of a company's equity and liabilities with its corresponding book values, as the replacement values of a company's assets is hard to estimate. Tobin's Q equals, it is also common practice to assume equivalence of the liabilities market and book value, yielding, Tobin's Q equals a per mil for stock-listed companies. The market value of equity is often quoted in financial databases. It can be calculated for a specific point in time by equals aggregate corporations equals. Another use for Q is to determine the valuation of the whole markets in ratio to the aggregate corporate assets. The formula for this is, the following graph is an example of Tobin's Q for all U.S. corporations. The line shows the ratio of the U.S. stock market value to U.S. net assets at replacement cost since 1900. Application: if the market value reflected solely the recorded assets of a company, Tobin's Q would be 1.0. If Tobin's Q is greater than 1.0, then the market value is greater than the value of the company's recorded assets. This suggests that the market value reflects some unmeasured or unrecorded assets of the company. High Tobin's Q values encourage companies to invest more in capital because they are worth more than the price they paid for them. If a company's stock price is $2 and the price of the capital in the current market is $1, the company can issue shares and with the proceeds invest in capital. In this case Q greater than 1. On the other hand, if Tobin's Q is less than 1, the market value is less than the recorded value of the assets of the company. This suggests that the market may be undervaluing the company. John Mihajlovic points out that no straightforward balancing mechanism exists in the case of low Q ratios, that is, when the market is valuing an asset below its replacement cost. In the case of the stock market as a whole, rather than a single firm, the conclusion that assets should be liquidated does not typically apply. A low Q ratio for the entire market does not mean that blanket redeployment of resources across the economy will create value. Instead, when market-wide Q is less than parity, investors are probably being overly pessimistic about future asset returns. Lang and Stultz found out that diversified companies have a lower Q ratio than focused firms because the market penalizes the value of the firm assets. Tobin's discoveries show us that movements in stock prices will be reflected in changes in consumption and investment, although empirical evidence reveals that his discoveries are not as tight as one would have thought. This is largely because firms do not blindly base fixed investment decisions on movements in the stock price. Rather, they examine future interest rates and the present value of expected profits. Other influences on Q: Tobin's Q measures two variables, the current price of capital assets as measured by accountants or statisticians and the market value of equity and bonds, but there are other elements that may affect the value of Q, namely, market hype and speculation, reflecting, for example, analysts' views of the prospects for companies, or speculation such as bid rumors. The intellectual capital of corporations, that is, the unmeasured contribution of knowledge, goodwill, technology and other intangible assets that a company may have but aren't recorded by accountants. Some companies seek to develop ways to measure intangible assets such as intellectual capital. See balanced scorecard. Tobin's Q is said to be influenced by market hype and intangible assets so that we see swings in Q around the value of 1. Tobin's marginal Q. Tobin's marginal Q is the ratio of the market value of an additional unit of capital to its replacement cost. price-to-book ratio. In inflationary times, Q will be lower than the price-to-book ratio. During periods of very high inflation, the book value would understate the cost of replacing a firm's assets, since the inflated prices of its assets would not be reflected on its balance sheet. Criticism: Olivier Blanchard, Chennai Ree and Lawrence Summers found with data of the U.S. economy from the 1920s to the 1990s that fundamentals predict investment much better than Tobin's Q. What these authors call fundamentals is however the rate of profit, which connects these empirical findings with older ideas of authors such as Wesley Mitchell, or even Karl Marx, that profits are the basic engine of the market economy. Doug Henwood, in his book Wall Street, argues that the Q ratio fails to accurately predict investment, as Tobin claims. The data for Tobin and Brainard unregistered trademark S 1977 paper covers 1960 to 1974, a period for which Q seemed to explain investment pretty well, he writes. But as the chart, C. Wright shows, things started going away even before the paper was published. While Q and investment seem to move together for the first half of the chart, they part ways almost at the middle. Q collapsed during the bearish stock market of the 1970s, yet investment rose. See also, P/E ratio, dividend yield, list of finance topics. Notes: Tobin's Q is sometimes written as Tobin's Q, or simply Q. It is also called Tobin's quotient, since the Q stands for quotient. Sometimes, people call it the Brainard-Tobin Q. References. Further reading: Smithers, Andrew. Wright, Stephen. Valuing Wall Street, Protecting Wealth in Turbulent Markets. McGraw-Hill. ISBN 0-07-135461-1. Investment Valuation, Tools and Techniques for Determining the Value of Any Asset. External links: Tobin's Q moderately bullish on U.S. equities. The Manual of Ideas launches Tobin's Q research service based on James Tobin's Q indicator. Robert Weber on the market valuation Q question. Andrew Smithers Q ratio FAQ, Q ratio graphs and data.